Hello there, everybody, and thank you so much for joining us today for one of our AT&T focused webinars here at the Retirement Group. My name is Samantha, and I am in client services here. I moderate these weekly webinars. In just a moment, we're going to be joined by our senior advisor, Tyson Mavar, and he's going to be speaking to AT&T employees about some value investing. But before we get into that presentation, I would like to very quickly remind you that although we work very closely with both AT&T clients, both active and retired, we are not affiliated nor endorsed whatsoever by AT&T. The Retirement Group is completely independent group of financial advisors, so please keep that in mind. Throughout Tyson's presentation, I will be adding some very useful resources, complimentary resources, into the chat. Please feel free to take advantage of all of those. They will guide you to to our educational library, where you can view a full library of all of our past AT&T focused recordings, as well as a link to an appointment with either Tyson Mavar himself or one of his colleagues after this webinar. And lastly, I would like to mention that after Tyson's presentation, I will rejoin him very quickly to ask him any questions you may have entered. If you find that you have a question about anything he's speaking about, please feel free to ask away. It's completely anonymous, and Tyson will answer as many questions as he can, time permitted. And with all of that out of the way now, I'm going to turn off my camera so Tyson can get started. Hey, Tyson.
Hi, Sam. Thanks for the introduction, and thank you folks for attending our webinar series today. My name is Tyson Mavar. I'm one of the AT&T focused advisors for the Retirement Group. Today, we're going to be talking about the current market and economy, as well as what our company believes to be the most successful investment strategy for a retiree. It's related to value investing. So what we've seen in this last several years, we've seen some unprecedented levels of government spending. We saw this primarily as a result of the COVID-19 pandemic. And what comes with high government spending? Well, the first thing most people are concerned about is what's going to happen to my taxes down the road. We're spending money that we are not even collecting in taxes today. Aren't we eventually going to have to pay our bills? And the reality is most likely, yes, we're going to have to increase taxes to start paying off some of these deficits that we've had. So that is certainly a concern of ours as advisors at the Retirement Group, given that most of our clients have a bulk of their money in pre-tax accounts like 401ks, IRAs, and in the pension that are going to be taxed at some unknown future rate. So we have an entire webinar focused on tax strategies and tax implications of government spending. But there's some other implications of this higher government spending, as well as lower interest rates, which is inflation. We definitely saw that in the last 2 years. We saw the highest inflation in over 20 years, and actually closer to 40 years what peaked in 2022, inflation rates north of 9% a year. So our dollars are becoming less and less valuable, and it's putting a headwind on our investments because our investments' real rate of return is net after inflation. The higher inflation goes, the higher returns we need to make in our investment accounts just to break even. It's another big risk in a retirement plan. Now, there has been some changes to financial markets in terms of how we're investing money as a result of this higher interest rate environment and the possibility of higher inflation going forward. So we're going to talk about all of these things and how they relate to our investment philosophy, specifically value investing. Before we get into the investment topics, though, I do want to breeze through the new interest rates that just came out that affect anybody retiring and taking their pension in 2024. It's based on November 2023 corporate bond interest rates. They came out at 5.5, 5.76, and 5.83 for the first, second, and third segment rate. This is how the company calculates not all, but most pension lump sums. And these rates are good for a year. They fluctuate on January 1st. If they go up, then lump sums typically go down and vice versa. They've gone up the last 3 years in a row. The lowest in history was in 2021. You can see those rates down here. The biggest increase that I've ever seen in my career, which is 13 years with the Retirement Group, was from 2022 to 2023. And many of you probably, and this might even be you, but a lot of people lost a lot of coworkers based on people looking to avoid lump sum losses and retiring to save money on their pension. So there were more lump sum losses the turn of this last year. Who knows what's going to happen this year? The Federal Reserve has suggested that they will reduce rates several times this year. Not only can we not rely on that fully, but there's also a difference between these corporate bond interest rates that affect your pension and the rates that the Federal Reserve controls. They are not perfectly correlated. So we'll be watching this closely this year, and stay tuned to future webinars so you can keep an eye on what's happening to the interest rates that affect your pension lump sum. Now, at the Retirement Group, we manage assets for retirees of AT&T and a handful of other companies. What that entails is first getting people retired and making decisions on how to take their pension, when to roll over the 401k, what tax and distribution strategy to employ. But eventually, once the assets roll over to an account like an IRA, a Roth IRA, a non-qualified account, or a combination of the three, now we have to reinvest those assets to, number one, produce cash flow to recreate the paycheck that our client is giving up when they leave AT&T, unless they're going right back to work. We also need to be cognizant of inflation. We want to at least meet, but in most cases, we need to exceed inflation so that the assets are growing and are around at least as long as our client is around, so they don't outlive their assets. We also need to be cognizant of our client's risk tolerance and risk appetite, because it's possible that if we set up the portfolio too aggressively, we could see a client that get some nerves when we have a bad market and just cannot stick to the long-term strategy, just sells their investments at the worst possible time because they fear the worst. So that is also in our minds when we're setting up these portfolios, the person's capacity for volatility. And our biggest objective as value investors is to avoid permanent loss of capital. And I'm going to talk to you about how we do that and why we recommend what we recommend to our clients. So value investing, we're buying solid companies, and it's not just stocks. When we buy stocks, we're buying a piece of a company. But we have the same perspective when we're buying real estate, when we're buying bonds, when we're buying groceries. We want to get the best value, which is the most reasonable cost for what we're actually getting from this product or this service or this investment. And it specifically is relevant to stock. So if we're buying a business, we want to buy a company that is not only a great company, they make great products, they have good management, their employee morale is good, they are growing. That's also a good sign of a solid company. There's something else that many investors overlook, and that's price. We want to look at all these quality aspects of a company, but we also never want to overpay for those aspects. In other words, we could love everything about a company, but we're not going to buy it if we don't love the price. We're never going to overpay for a good company. We want to have a great company at at least a reasonable price. We might not always be able to find it at a great price, but a reasonable price, not an expensive price. That is one of the key mistakes we're looking to avoid as value investors. So we do this by looking at the fundamentals of the business. We look at the balance sheet, the income statement, the statement of cash flows. We're looking for a solid company that doesn't have a whole lot of debt, doesn't have risks associated with taking on too much debt. We want to see consistent net income, consistent profits. We want to see revenue. We'd like to see growth, but we're happy with a company that's just staying consistent as long as the price is reasonable. And what we found is also some people get too excited about growth and will way overpay for a company because of a couple years of growth. That is also something we oftentimes want to avoid, because you can't always anticipate the growth will continue. So we're as if not more reliant on and focused on the current soundness of a company as opposed to where we expect it'll be in 2 to 5 to 10 years. We look at different metrics and key ratios, which compare the price of a share of stock versus something, for example, like the earnings per share of stock, or a PE ratio, or the price to book ratio, which is comparing the price to the value of the net assets, assets minus liabilities of the company. And there's a lot of different ratios like this that will help us get an understanding of the fundamentals of the company relative to the price, and then we can compare that to all stocks at a broad level or specific to the industry to start to come to terms with, is this a good deal or not? We like to identify investments that are generating yield, and that doesn't necessarily mean paying a dividend. While dividends are good for a retirement portfolio to produce income, some of our clients overemphasize the importance of a dividend. And I always go back to the example of Berkshire Hathaway, a company that hasn't paid a dividend for about 60 years, but performed over 20% a year on average during that time frame. And what Warren Buffett, the manager of that company, has said, if you need income, just sell shares, because it makes more sense for that business to reinvest their retained earnings into good ideas than to pay it out to investors. At least it has during their track record. And the same thing goes in a retirement portfolio, although we need to also be cognizant and aware of the tax ramifications of a dividend versus a capital gain if we're selling shares to produce income, for example. We also want to identify great money managers. I'll go back to the Berkshire Hathaway example. Phenomenal management team. Warren Buffett has been the CEO of that company for a long time, will not be forever, but we want to look at who's managing the company. We also want to look, if we're diversifying, if we're buying a mutual fund or a diversified fund of any sort, we want to look at the management. What's the track record of management? How do they make decisions? What's their perspective? Their prospectus. So essentially, what are they bound by in terms of their decision making when they are buying and selling stocks? Are they able to hold cash or not? What is the stated objective of the fund and the manager, as well as the stated objective of a company when we're looking to hopefully buy a company forever? That's what Warren Buffett says is his favorite holding period is forever, although that doesn't always play out and is not always in our interests. Now, our primary objective is to avoid permanent loss of capital. And there's a big difference between temporary loss of capital and permanent loss of capital. Temporary loss of capital would be a fluctuation in your stock. We all expect that our stocks are going to fluctuate. That's what we give up to gain the growth potential of a stock, is the day-to-day certainty of what its price is going to be. If certainty is your objective, you're going to have to give up growth and go toward an investment such as a CD that it's not going to pay you as much, but you have the predictability or the certainty with that. So we know we're going to have volatility with stocks. That's why we want to buy good stocks and have patience that we're going to hold on to this thing for a little while, as long as the fundamentals still meet our goals. As long as nothing has fundamentally changed about this company. If it goes down in price, we might actually want to buy more of it rather than get nervous and sell it. And this is our primary objective as value investors, avoiding permanent loss of capital. So an example of that would be buying a company that goes bankrupt while we own it, or buying a company really expensive, maybe using the year 2000 as an example, buying a tech company in 2000 and buying it so expensive that we never see that stock return to the price that we bought it. That would be another example of permanent loss of capital. Or selling an asset because the allocation of the portfolio was too volatile, it was fluctuating too much for our own psychology. We didn't have the stomach to absorb that volatility, and selling it when it goes down because we fear the worst. That would be another example of permanent loss of capital. All of these play into our decision making when we're building a retirement portfolio. Something else that's unique to value investing is we're looking to buy investments with a margin of safety. In other words, we're looking to buy something on sale because not only does it increase our probability of gaining on that investment, of having a positive return if we can buy it on sale. More importantly, as a value investor, it reduces our probability of permanent loss of capital if we could buy something on sale. For example, if we got something at a 20% discount to current intrinsic value, and the intrinsic value of a company drops by some unforeseen event that happens, maybe it's the political climate or regulations that negatively affect our business, or a competitor that comes out of nowhere and takes over some of our market share. That's something that we can't always control or predict, but if we buy on sale, it gives us a buffer to absorb some unpredictably negative outcomes related to the profitability of our business. So reducing permanent loss of capital, buying with a margin of safety, and then ultimately having an investment that is fundamentally sound is going to help reducing our probability of losing money in a retirement portfolio. More important than when we were working, because in retirement, now we have this constant cash flow need from our portfolio that we didn't have when we were working. So it becomes even more important to have a thought process like this, where we are reducing volatility, reducing probability of permanent loss of capital, and having investments that are going to help us fight inflation over the long run. There's an example. I'll zoom in here. We have the Russell 1000 Value Index versus the Russell 1000 Growth Index in purple and orange, respectively. Orange is growth, purple is value. So you can see there's times where value outperforms growth, and there's times where growth outperforms value. And in this bottom table, you'll actually see it's almost like the tides, where there is what they call sector rotation. There's could be periods of time where value outperforms growth, periods of time where growth outperforms value. And it's usually not just 1 year and then out of favor the next. It's a segment of a series of years in many cases. And you can see that, like the tides, value will have a stretch of a few years. It might be as long as 10 years that it outperforms growth, and then a period where growth outperforms value. Almost impossible to predict when that's going to happen. But if you look at the long run, rather than trying to predict this, if you just invested in value stocks and not even tried to pick good value stocks or hired a manager to pick good value stocks, you just bought the value index, you would have outperformed the growth index in most instances. And we actually have an interesting quote going over this. In most instances over the last 100 years. Here's another example of how you can use value investing to help reduce your probability of permanent loss of capital just by using 2022 as an example. This blue line, value stocks, the Vanguard Value Index, the red line being the Vanguard Growth Index. Look at this, negative 4.58% that year versus negative 34.06% that year. Those bad years, negative 34.06, can destroy a retirement plan, and that's what we're looking to avoid, is that high volatility in a retirement portfolio. And not only is it going to improve our financial experience, it's going to improve our psychological experience in retirement, we found, because we're just not so nervous about what's happening to our money, especially when we don't have a paycheck anymore. That's when the nerves get really, really amplified, when there's volatility in the value of our assets in retirement. So here's Charles Robinskoy. If you ever watch CNBC, this guy's on there all the time. He's a manager of a very successful fund. And a quote that we took from a recent interview with him: if you go back to 1926, value has beaten growth every 10-year period except the last 10 years. And what he was getting at in this quote is that value is as cheap or cheaper than it's been in the last close to 100 years. If every rolling 10-year period value is beating growth except for this last one, chances are growth is more expensive and value is cheap relative to one another, and even bigger incentive to overweight value, at least in our opinion at the retirement group, in the stock portion of your retirement portfolio. Now, here we are in an election year in 2024. I wanted to go through this chart, and we'll see if we can zoom in a little bit because it is rather small. Here we have election years going all the way back to 1964. We have the performance the 12 months prior to the election of the S&P 500. Then we have the performance 12 months after the election. And then we have the actual calendar year of that election year, which is, essentially 11 months before, well, I guess 10 months before and 2 months after the election. You can see both Democrats and Republicans here. It goes all the way through 2020, Joe Biden. And then we have some averages here. So, it's probably not a whole lot of predictability out of this by, trying to figure out what the market's going to do, whether a Republican or Democrat gets elected, whether or not it's good to be invested in an election year. Our opinion is to stay invested and reallocate and rebalance periodically, and make sure you're just invested in the right areas, focusing on value like we've talked about. Hopefully this is optimistic, though, because there's averages here. You can see 8.4% in the election year was the average of all these election years. That's what the S&P 500 performed, total return. 9.3%, 12 months after the election, and then 8% average the year of the election, the calendar year. So these are S&P 500 returns, not too much different than average returns of the S&P 500 over time. I would say that they are just a hair lower than the long-term averages, but you have wide variations. I mean, 2008, the S&P 500 was down 38% that year. A lot going on that year, but then you have other years where, like we see in 1980, the S&P 500 was up 25, almost 26% that year. Not a ton of predictability, but we also have seen more volatility in these election years because of the uncertainty on both fiscal policy as well as monetary policy and what that's going to mean to the economy and financial markets coming off of the election, especially now that we have both a presidential as well as a midterm, congressional elections coming up here in 2024. So like we talked about high government spending, we saw some unprecedented levels of government spending in the last several years. What definitionally is a recession? We could see one in the next couple of years. Well, the general definition of recession is widespread decline in economic activity. However, the technical definition of recession, 2 consecutive quarters of declining GDP growth or negative GDP. Which is gross domestic product. It's the productivity of our country, how much goods and services we're producing. Typically, we see this number growing over time, but if we have 2 quarters of consecutive declines in GDP, we are, quote unquote, officially in a recession. So who knows if we're going to have one this year? We have seen some metrics that we'll show in a bit related to interest rates that historically have not been too bad at predicting recessions. But that doesn't also mean that you should try to time the market and pull money from stocks if you do anticipate a recession is coming. So first, let's talk a little bit about bonds and, first of all, how they work, but also how they're used in a retirement portfolio to mitigate the risk of stocks in the portfolio as well as produce income. Treasury bonds, government bonds. They have a range of maturities. These are backed by the full faith and credit of the U.S. government. They pay less than corporate bonds because they are safer, or at least they are perceived to be safer because they are backed by the taxing authority of our government. In other words, if we get into too much debt, we could just tax our citizens and come up with the ability to pay these bonds off rather than defaulting on these bonds. The United States still has a very productive economy, which is one of the reasons we pay some of the lowest interest rates on our debt in the world. Now we also have municipal bonds. Now these are state and local government issued bonds, also safer, at least perceived to be safer than most corporate bonds, but not as safe as treasury bonds because they are not backed by the central bank or the Federal Reserve. And there's different types of municipal bonds. We have general obligation that is based on the general fund of a state or local government. In other words, can be backed by the tax revenue from that state. Then you have revenue municipal bonds, which are based off of some type of a project like a toll bridge or a toll road, for example, wherein the bond is paid back by the receipts or the revenues coming from whatever the project the bonds were originally issued to be able to produce. Also, some tax benefits to municipal bonds, at least at the federal level. You could get some tax deductions, which is why municipal bonds might pay a little bit less in interest because they know that there's some tax benefits in buying them. So there's something that they have as a tax equivalent yield of a municipal bond. In other words, the interest that you're getting plus the tax benefit you're getting, we'd want to look at that too. And we're typically not going to recommend you buy those in an IRA or retirement account because there's already tax deferral in that. This is something that we might buy in a non-qualified account to help improve the tax efficiency of your portfolio, as well as have a good income-producing fixed income investment in the portfolio. And then we also have corporate bonds. So these are bonds or debt instruments issued by corporations like AT&T and many others for purposes of raising money. So there's a variety of ways companies can raise money. They can borrow from a bank. They can issue stock, so share profits with more shareholders. And they can also borrow through the use of a bond issue. In other words, they're going to issue usually in the billions of dollars, or a company like AT&T, or hundreds of millions at least. And all sorts of different time horizons, short-term, long-term bonds will be issued. But the point is corporations have to pay a higher rate of interest because their bonds are riskier than a treasury bond or a government bond. And the better rating that company has, the less interest they typically have to pay because it's a safer bond. People are more attracted to safer bonds and are willing to accept a lower rate of interest if that company has very little debt, for example, or if that company has a very low probability of going out of business. Now, traditionally, bonds have been considered a safer investment than stocks, first and foremost, because in the event of default or bankruptcy, bondholders get paid back before stockholders. And so there is an element of safety there. But they have traditionally been less volatile. And although they don't grow as much, they are dependent on not only the solvency of the company, if it's a corporate bond, the company that's issuing that bond, but also interest rates. Interest rates affect bonds in many cases very severely. We saw that in 2022, and interest rates went up faster than they've gone up in a long time. Bond prices got hammered, and what many clients of ours prior to retiring had assumed was that their bonds would be safer, or at least not quite as risky as their stocks in a rising interest rate environment. That's not always the case. Now, if interest rates go down, oftentimes bonds are going to go up in value, and that is another possibility if we see interest rates coming back down in the next couple of years, but certainly a risk that needs to be considered when building a portfolio and also investing in bonds, whether you're investing in bond funds or direct individual bonds, that needs to be considered when putting together this plan for a stream of cash flow. Now, in a recession, typically corporate bonds are going to get hurt, especially the high yield, also known as junk bonds, bonds that are below a certain rating. They pay more interest, but they're going to get hurt more in a recession because not only does their probability of default go up in a recession, more companies go out of business in a recession, but also because there's going to be a flight to safety where people are selling risky assets and buying risk-free or lower risk assets like treasury bonds, which is just going to affect the demand for high yield or junk bonds such that their prices are going to go down. So all of this needs to be considered when building this portfolio, not just the stock side, but the bond and fixed income side. And you also may want to consider an advisor that has the ability to offer alternatives to bonds like annuities, some type of investment that doesn't react exactly like stocks or bonds to changing interest rates or the changing economy. And our advisors at the retirement group, including myself, are insurance licensed. But not all of our clients like or want that type of investment, but it doesn't hurt to have the ability to get advice on something that is unique to stocks and bonds for protecting your capital. Annuities are one example of that. Not always appropriate, but in many cases can be a good portion of the safe side of the retirement portfolio, depending on your and your family's circumstances. So managing the bonds in a recession, we want to be very cognizant of duration, which is the interest rate sensitivity a bond price has. When interest rates go up, how much does the bond go down? In part, that's the length of the maturity of the bond, but there's other factors to that. Using bond mutual funds or bond ETFs to invest in versus using direct bonds, and the implications of interest rate changes to those funds versus direct bonds, and focusing on quality first and foremost, not quantity. So in other words, not over diversify, not trying to buy a portfolio that's so large we're buying the junk with the quality. We want to focus on high quality and not just diversify to diversify. This is a great chart. This is a yield curve. A yield curve is interest rates that are plotted out based on the maturity of certain bonds. And we have 4 different time frames here. So we'll start with the light blue. This is a normal yield curve where longer term bonds pay more than shorter term bonds. So you see the short term bonds are near zero. And up until they get to about the 5-year treasury, those bonds are zero. And then they go up. They were barely at 1.5% for the 30-year. This is back in June of 2020. My, how things have changed since then. The green line is not too much different, but that was June of 2021, still a normal yield curve. Then we have June of 2022, still for the most part a normal yield curve, where higher or longer maturities are paying higher yields. And you can see all rates have climbed that year. And then here we are in 2023, June of 2023, inverted yield curve, wherein longer term maturity bonds are paying less than the shorter terms. And you can see the short terms are north of 5%, all the way up to the 1-year treasury. And then we go out to the 30-year and they're only 4%. So while some people may want to lock in a higher return than we've seen in 15 years on these types of safe assets, treasury bonds, and go for a longer maturity, there's many people that like the liquidity of a shorter term maturity, and they're actually paying more right now, which is unique. Why I wanted to bring this slide up, though, is because historically, not always, but typically, an inverted yield curve has been indicative of a recession. Not always, but most of the time historically. Now, does that mean we're definitely going to go into a recession this year? Absolutely not. But we are certainly prepared for that when we're building our portfolios. What does that mean to our stocks? What kind of stocks will we favor in a recessionary environment? And maybe even a stagflation environment where we have both a declining economy and increasing prices at the same time. That is a very scary environment to be in economically for any society. But we need to be prepared for that, especially in retirement portfolio when there are no do-overs. You only get one chance to get it right. So we need to make sure that we are defending against every possible risk out there on your retirement money. Now let's talk about rollover strategy. So most of you know when you leave the company, you don't have to, but you have the option to roll over both your pension if you take the lump sum into an IRA, individual retirement account. There's no taxes when you do that. There's no taxes until you start pulling money out of the IRA. Same thing with your 401k. You do not have to move money from your 401k, but the reason most people will move their 401k into an IRA after they retire, is because that's the first time all of the money's been available. There's some examples of people that have some money they can roll over to an IRA even before retirement. In fact, that's how many of our clients started a relationship with us, is what we call an in-service rollover, had us manage a small portion of their 401k before retirement to make sure it was a good fit before they entrusted us with their entire life savings in many cases. Once you get to retirement, now all that money is available to be rolled over. And the reason most people do that is because there's vastly more investment options in an IRA than there are in the 401k. Now, that doesn't mean that it makes sense in every case. There's costs you want to be aware of in an IRA that might not exist in your 401k. There's tax advantages in the 401k, especially for somebody who's not yet 59 and a half. There could be a big incentive to leave money in the 401k rather than rolling everything over to an IRA. All this needs to be discussed with your advisor or somebody that you trust has experience in this realm before you make any big decisions, because many of them are irrevocable and you cannot go back on them. So this is typically what you'll go through, though, when you're leaving AT&T, recreating a paycheck from these assets, you start pulling money from the IRA or the 401k at a rate that you and your advisor has found to be sustainable given your risk tolerance, your other assets, your propensity to work, all these other things that are built into your cash flow analysis. It's possible you may have some after-tax money or what we call spillover contributions in your 401k, and that we'd want to know about as well, because in most cases that makes sense to roll over not to an IRA, but into a Roth IRA, so you can get tax-free growth going forward. And I would actually encourage you to consider doing this before you retire. Almost all of you have this option available if you have any after-tax money in your 401k that should be growing tax-free, but in the 401k, it's not. This is something you might want to consider talking to us or somebody about, maybe being more tax efficient in your 401k by getting those after-tax dollars out of the plan and into an environment where all the future earnings are tax-free, which specifically is a Roth IRA. Let us know if you're not certain how this works and would like some help understanding it. And once we get to that point of approaching retirement, it's very critical we run a plan. We found actually statistically 74% of Americans do not have a written plan for their retirement. And there's just no reason not to, folks, because a variety of companies, including ours, a retirement group, are happy to do this for you on a complimentary basis. Take a look at your 401k, help you run pension projections, put it all down on paper, a roadmap for your retirement, start to identify what risks will likely affect you more than maybe some other people. some considerations as you approach retirement, how you're saving, how you're investing, which option you're leaning on the pension, and start to build some confidence in your game plan, your strategy for transitioning from AT&T, whatever that means. It might be a forced reduction. We've seen a lot of surpluses happening. Saw a lot of people forced into moving, and some people that chose not to as a result they now are working somewhere else and couldn't stay on AT&T. It's got to be ready for everything because the company is constantly making changes, and we want to be able to pivot easily. Building this plan, I am very confident you will find to be a good investment of your time. Doesn't cost you anything except for a little bit of your time. So let us know if you have interest in having us do that for you. With that, we're going to wrap it up. In fact, we might have had some questions that I'm going to pass it back to you, Sam. If we did have any questions, I'm going to spend a few minutes going through any of them that came up today, okay?
Thank you, Tyson. Yeah, let's answer just a couple questions. We're running a little short on time today.
Okay.
This first one, how could the election outcomes specifically affect AT&T stock performance and in turn our employee stock ownership plans?
Yeah, that's a pretty tough question to answer.
Yeah.
Election. So, we have Democrats versus Republicans. That's the big stark difference in terms of who wants to do what, right? In terms of taxing us, in terms of the regulations, in terms of government spending. Those are the big three issues that we're looking at when we're focusing on the economy. How that affects AT&T? Well, I would say that what happens with interest rates has an even bigger impact because of the amount of debt AT&T has accrued in the last decade. As an owner of AT&T stock, you should be rooting for lower interest rates. That will help, and that helps most companies, but certainly companies that have built up debt like AT&T has, a lower interest rate environment would be more favorable for AT&T. And I'm not going to speak on, whether Democrats or Republicans will be kinder to AT&T's stock price. I would encourage everybody to diversify. If you still have most of your 401k or life savings in AT&T stock, it's certainly been a tough last few years for you. This is why we recommend diversifying, because we cannot predict the long-term outcomes of any company. Even if with a high degree of certainty, we still want to have some protection against the uncertainty. And that's what diversification is good for, having lots of different asset classes, lots of different holdings. And that way, the unpredictability of elections and central banks' decisions and politics overseas, regulations, the environment, the economy, pandemics, all of these uncertainties that come our way, diversification can help reduce the volatility and the uncertainty of our sacred retirement assets. So I would probably encourage that person just to call in. We'll talk through your own 401k and what this year looks like, but also, are you allocated correctly given your time horizon and risk tolerance as you approach retirement from AT&T?
All righty, thank you. We're going to answer just one more. Before I ask you this question, Tyson, I would just like to remind everybody that there are links in the chat. If you'd like to book an appointment with either Tyson himself or one of his colleagues, please take advantage of that. And the cash flow analysis link, which is complimentary. So those are both there for you guys to use. All right, Tyson, what are the best practices for managing both my AT&T pension and 401k plans to ensure maximum security and growth, especially in a potentially volatile market? That's a long-winded question.
Thoughtful question.
Yeah.
A relevant one for today's discussion. Value investing is a great philosophy. It's not the only successful philosophy. I would argue that it's the most successful investment philosophy, given that Warren Buffett is one of the practitioners of this, who is one of the more notorious value investors. But there's the school of thought. People that follow this school of thought have phenomenal success if you look at the track records of many investment managers. And, just the way that we live and spend money, I think it's, not many people would argue that you want to be looking for value whenever you're purchasing something, including investments. And so I would encourage that person to set up a meeting so we can first run their cash flow analysis if we haven't done so yet. And then we can start to apply value investing to their thought process when it comes to building their retirement plan. And then also, it's not just the investments, it's the tax strategy, it's the timing of your retirement, it's getting every dollar you possibly can out of AT&T and your benefits. Those are all important issues when you're approaching this transition and going into being financially dependent on AT&T to financially independent, being dependent on yourself and your own assets. Very important point in your life and a very risky part of your life that we can add some value and be a part of this decision-making process for you. So yeah, give us a call and we'll put that together for you. Happy to.
All right, Tyson, that's all we had time for today. I wanted to thank you, Tyson, especially for, all of your knowledge today. And we want to thank everybody else for joining us. We hope we see you again soon. Have a good day, everyone.
I'll take care.
Bye.